Todd, welcome back. We are excited to have you back. It's been way too long.
Absolutely. Always enjoy talking with you guys. It's fun with people that are in the same business and really have a passion for helping people and doing what we do, right?
Well, Todd, you're right. You got a passion for helping advisors, just like I have a passion for helping Cameron. So that's kind of why this just all works so well.
That was in the first 30 seconds.
Yeah. It's going to be a good one.
That's a
It's
pretty
Friday.
big lift, though. That's a pretty big load on you, Anthony, isn't it?
It is, but you know what? I've been doing it for so long. So it's good to it, but it's part of my service project. My service hours is helping with Cameron, but
Oh, that's cool. That's good of you to work in that area for sure.
Todd,
you're right, Todd.
I'm gonna do my best to have Anthony not talk about himself today. So I'm gonna throw it back to you, Todd. We are very familiar with you. We've known you for a very long time. I'm a huge fan of what you've done for kind of the advisor community, but for some of our listeners, they might be new to you. If you could maybe give us a little background on how you got into this industry, and then also lead us into truth concepts and what the software provides for the advisors.
Sure. I guess I should say this. I think it's the truth. I don't know that anybody gets here on purpose. Like, when you're asked when you're asked as a kid, what do you want to do when you grow up? Financial advisors, not on the list, I don't think, of what, kids usually answer. It's usually, firefighter, policeman, all those good things, right?
Yeah.
But I think, unfortunately, it's an industry that's really missed. I mean, if you have a passion for people and their future and generations of people is really what we impact. It's there couldn't be a better industry to be in, I don't think, because of that benefit that comes in, again, helping people. I started early on working with a big estate planner, and we kind of got introduced to a more personalized form of helping people one-on-one rather than bigger corporations and larger estates, and really found a niche. Actually, initially tried to disprove some of the theories with spreadsheets, and in those days it was Lotus spreadsheets. If anybody remembers that,
I remember Lotus,
Excel, or anything else, right? And out of that, I found how the math really works behind a lot of the theories that were out there about finances, and especially in the world of whole life and the benefits that it has on as a tool used in the right strategy for people. And so out of that, I created software, and it's just grown to the truth concept software that we have today. And I get to teach advisors. I get to share my passion. I get to really use the tools that excite me.
You mentioned there the how the math really works. I think that a lot of people assume that pretty much every advisor out there knows kind of how the math really works, but I don't think that kind of traditional advisors, or maybe your typical advisor, right, has a good idea. Why is there this disconnect between what most advisors out there are saying versus kind of how this math and the money really works?
Yeah, there are a lot of pieces to that question, and we can dig into them as we go. But one of the big things is we look at the financial industry and we think, hey, this is based on mathematics, right?
Yeah.
So it must all be right. Well, if it's all right, then how could you have contradictions? So something's right and something's not right. Okay, well, how do you have misinformation in something based in math, right? I mean, I know in the last little while, time-wise, that now you can get partial credit for math. I don't understand that, because math is either right or wrong, right?
Yeah.
There's no gray in math, right?
That's the beauty of it. Yeah.
Mm-hmm.
And yet that's what they've introduced in the schools. It's kind of crazy to me. So, it's either right or wrong. But
now somehow math has turned racist. Right, but like 2 + 2 is 4.
So the roads,
sorry,
apparently.
Sorry. Well, so you look at that and you say, well, how could that be? How could you have misinformation if it is based in math? And most of the time, the math is correct, but the formula is wrong. Okay. In other words, There may be a 2 plus 2 in there and the answer is 4. That's fine, but we're not dealing with 2 plus 2. We're dealing with time, and that creates a different component altogether. And that's what's left out so much in this industry. And what I mean by that is, so when we learn grade school math,
Yeah.
right, it's flat and linear. It's all about the now. And that's fine. But when we shift into finance and we add the element of time, grade school math doesn't work anymore. It's a whole different element. And if we don't account for time value of money, then our answers may be, the math behind what we did may be right, but the formula again is wrong because we haven't accounted for time, and that makes a big difference. And so what we see is examples taken out of time, and the comparisons are interesting because a lot of times, like on the investment side, we'll see something compounded, in other words, using the time value of money. So it's compounded out over time to get an answer out in the future. And then the costs, instead of also compounded out, they're just all added together, right? Well, that's a serious misrepresentation. Not a lot of times, not on purpose, just it's a lack of understanding, right? And we have to always, when we're talking about finance, is include the time value of money, unless we're talking about just what's going on exactly right now. But typically, that's not the thing, right? We're looking out 30 years. Well, okay, if we're looking out 30 years, then time has to be entered into the equation.
Todd, what for some of our listeners and for Cameron, can you define time value of money?
Well, time value of money is the values of dollars over time. If it gets a little confusing, I think, for people, and why it's kind of avoided with the idea of opportunity cost. So on the accumulation side, I think most people understand the time value of money, right? It's the idea that if I put money in this account, that it grows over time and I get interest on that this year, and next year I get interest on that plus interest on my interest, and that compounds over time, and that gives you the time value of money. What's less obvious for people is that is the time value of money on costs. And the same thing happens. If I have to pay taxes on an account, if I'm comparing one account that doesn't have any tax on it against another account that has tax on it, I can't just add up those taxes over time and subtract them off of the result, because each one of those tax dollars I paid had the ability to have done much more than that. Okay, well, that sounds like kind of phony math. It's like, yeah, but I didn't have the money, so I didn't do it. So how can we compound it? But I'll tell you how you can see it is because in the real world, people have a finite amount of money, right?
Mm-hmm.
Okay, so that money had to come from somewhere. And eventually, if your accounts are growing, that tax gets bigger and bigger. You're going to have to start taking it out of your other assets. Well, when you take it out of those assets, you can actually see, man, this didn't just remove the money by the cumulative amount of the tax I paid. It removed it by the amount of tax plus the interest that I should have earned on that account. And then it starts to come back around. And so those are some of the pieces that are really difficult for the average person to understand, and why a financial advisor really needs to understand it and help relay that to their clients. Right.
Todd, you said early on you had looked at the math on Whole Life. What did you learn? Was there a misconception that you thought, but then when you did the math, you thought something different?
Well, it's like, so life insurance, and I think it's earned the reputation, really has an idea of, oh, that's a terrible rate of return or whatever else, right? And it goes back to something that Cameron mentioned early on when we were discussing things, and that is that there are so many additional pieces with the whole life insurance if we understand how they fit. And like anything, it has to have a strategy around it, right? We have to see how it fits in somebody's world. And with life insurance, it had this terrible reputation until you look in it and actually find out what's going on. And I think part of the reason it has a terrible reputation is because everybody's trying to beat up on it, right? If you're if you're trying to sell an investment, your competition is whole life insurance. Okay. So you've got the whole industry really trying to beat up on life insurance because it's misunderstood. And we have to go into deeper area to really understand. So let me shift gears just a minute. So think about this, and this is what happens a lot of times at a cocktail party or something like that, right? Somebody runs into a financial advisor. They find out, hey, you're a financial advisor. What should I invest in? Okay, so what do they want? They want an immediate answer. And what does the advisor want to do? They want to give them an immediate answer. Okay, well, why is the financial industry that way? So let's change the scenario a little bit. Let's say that there is a house builder at this cocktail party, and you walk up to them and find out they're a house builder. Oh, cool. What does a house cost me? Could this house builder give you an answer with that information?
Not at all.
How many people are going to live in the house? How long do you want the house to last? Is this going to be the house, or are you going to sell it sometime in the future? Is it going to have carpet, or is it going to have tile? Is it going to have high-end appliance? All those things have to be discussed. But when it comes to finances, and you say, well, it depends, people don't understand that. Well, what do you mean it depends? Just tell me what the best thing is I should put my money in. Well, you can't do that without getting a bigger picture, right? And so that bigger picture is hard for people to sit on, but you have to know that, because the strategies that occur are important as to what fits those pieces. What are those goals? What are those desires? What is the long time piece that you want to do? And like when Chris and I were talking about it, he said, many times you're looking at comparing one asset against life insurance immediately this year. Well, wait a second, this is a long-term planning tool, right? We need to look at it over the life of what you're going to be doing, Mr. Client. What do you have in your future? What does that look like? We can't look at everything today without, again, having that element of time in there and seeing how those strategies impact. Because one of the things that I found out, and this goes back to finally answer your question, Anthony, and that is, what does having that life insurance in place in the future do to unlock the other assets that we have? And what we find out is that whole life insurance paired with other assets makes all those assets way better.
Mm-hmm.
How so?
Well, one of the ways is that I like to kind of talk about with clients is, let's say that you knew without a shadow of a doubt that in your future you were going to win the lottery.
Mm-hmm.
Would that change how you spent money today?
Yeah.
Yeah,
absolutely.
Right?
Yeah.
It unlocks other assets because that's going to be dropped into your estate at some point in time, right? And that's what we see with life insurance. That's one of the big aspects that can occur. Hey, if I know that this is going to come in at my death and replace this asset and continue to do the work that I wanted to do in my lifetime, now I'm free to spend some of my other assets in the most efficient way that gives benefit to me while I'm alive. So people look at life insurance, they look at the death benefit side and say, well, that's something that's going to be left to somebody else. And as a young person, that idea of legacy is a lot of times less important than what it becomes later on. And we've had, clients after clients after clients that started in the area of, I earned mine, my kids can earn their own mentality, to what if we only ate every other day? Then could we leave money to the grandkids? So, right?
It's always the grandkids, right? It's never their kids.
And so the point is, at that point in time, it's too late to set that up. But what if we did it ahead of time and it didn't cost us anything to do it? And so that if we have that mentality, we can actually take advantage of that in the future. But really, more importantly, or at least as importantly, I think, is because that is going to happen in the future, we get to more efficiently spend the money that we've put there, right? It becomes the kind of the permission slip to allow us to spend our assets in a way more efficient way than we would if we didn't know that was coming in to replace it.
Todd, actually, what you just said hit home with me. Like when I first got in this business, one of my mentors was talking about the legacy, and I was like, I didn't say it out loud, but I'm thinking, man, I want to make sure I can pay my mortgage, and I'm trying to pay my bills. Like, the last thing I'm thinking about is leaving money for other people. But then as my career grew and I became more financially astute and had some more assets, now I'm start thinking, particularly now I'm thinking, now I have a grandchild, and I'm start thinking is how difficult this economy or buying a house is now. How difficult is it going to be for my son and my grandchildren? So now I've really changed my legacy goals, but part of it was I needed to get to a certain level. I needed to make sure I took care of my immediate family, immediate bills, and now I'm more open up to helping the next generation.
Yeah, and there's an interesting thing, the whole black swan idea. I think you guys are familiar with, and that could anybody have predicted COVID? No. Could anybody have predicted 9/11? No. Could anybody have predicted 2008, 2009? No. Well, not exactly what it was, but that something was going to happen. Absolutely, right? Mm-hmm. And so many financial plans are put together with the idea of everything works out perfect, you're going to be in good shape. Well, guess what? It's never worked out perfect. That's why that's why we have black swan events. We don't know what they're going to be, right? But we know there's going to be something. And so one of the things that I talk often to my clients about is this idea of, look, most of my clients would rather have 100% chance of getting a 95% of their target wealth than a chance of getting to 100% and a strong likelihood of well less than that, maybe less than 50%. Okay. So in other words, trim it a little bit off to make sure it happens is much better position, knowing that we're going to have events over the next however long that is. And that time frame's getting longer, right? We're living longer and longer and longer and longer. So it becomes way more important to have that stuff in place and be able to guarantee that it's going to be in place. And so many people look at the protection side as being against the accumulation side. But what if we could do both? Wouldn't that be cool?
Great.
Sorry, I'm not sorry. I'm interrupting you. But
yeah, go ahead.
You'd mentioned about these black swan events and that we can't predict them. Definitely true. But if we look back at history, there's some black swan events. We don't know when or what they're going to come, but they have come. And, Cameron and I did research and went back to the 1900s. There's been a recession every single decade. So there shouldn't be a surprise that there's going to be another one. We just don't know when or how long. But just like you mentioned, that's something that we need to incorporate in our overall plan, because there's going to be some sort of black swan event. And, 08 is what really opened up my eyes, because I anticipated everything was going to go just how my financial planner had told me. And then
you weren't very smart then, were you, Anthony?
He still isn't, Todd. He still isn't.
But now, knowing that there's going to be some sort of event, we can plan for it, not only to protect our family, but also that can create opportunities. Because the people who didn't plan, assets are going to be on sale. The banks are going to tighten up, and we're actually seeing it now, particularly on these regional banks, which means there's going to be some opportunities, and we need to be in a place where we have liquidity so we can take advantage of those opportunities.
Absolutely. And that's, the position of cash is such a great position to be in, but who wants to be there at 0.5% or less, or 0, or even having banks charge you for having money sitting there, right?
Yeah. And I know, Cameron, you were going to say something, but I'm going to interrupt you one more time.
You done yet? You done yet?
I just want to take a little moment to know, when we have a podcast interview, we're streaming it on LinkedIn, YouTube, and Facebook, which not only can you get an unedited version, but also, more importantly, you have the opportunity to ask us questions. So if you're watching live now, feel free. If you got a question for Todd, or you have some question about hair care and Paul Mitchell, throw a question in the comment, and we got the time to answer. And if you're watching the recording or listening on your car, let's make sure that you don't miss these opportunities. So we suggest that you subscribe to our YouTube channel to be notified. Now, Cameron,
may I speak finally?
Yes,
I wasn't
please.
even joking earlier. Todd thought I was joking when I said I'm going to try to keep Anthony talking at a minimum today, but I'm not. I'm failing so far. Todd, the idea that I had earlier was we meet clients kind of face to face, and what you had touched on a minute ago is just kind of talking about some of the way that clients view their financial investments and those things. What I found is it's very short-sighted. And the example that came up was that I was talking to somebody the other day, and we looked at it kind of one strategy versus another. In about 10 years, they were about even. And the client was like, well, this is crazy. Why would I ever do it? And then we extended that out to 30 years, and there was well over $1 million difference between the two strategies, right? And so I think part of the education that we give clients is have a much longer, broader perspective on it. But my question, right, is I know that you deal with a lot of advisors, and a lot of advisors are kind of approaching truth concepts and getting exposed to some of these ideas and truths a little bit differently. What's been your experience with the way that some of the advisors, maybe from the investment side, have kind of embraced or not embraced some of the teachings that you've had over the years?
Well, you know, it's an interesting question because as humans, we don't want to be wrong.
Yeah.
You know, we don't.
Especially CPAs. Yeah. We do not want to be wrong.
They're always wrong, aren't they?
The zing. All right.
Yeah.
You got a zinger against me, but remember, that's only half a point. But, okay.
No, but you know, nobody wants to be wrong. And yet what we have, if you really want to get to the truth, debate's going to have to happen, right? And it's going to have to be friendly debate, not the kind of debate that we see this day and time. You know,
Yeah.
people used to be able to come together and actually debate to try to get to the truth. Instead, now it becomes name calling and cancel culture and that kind of thing when we start to talk differences. And so, you know, I think even in a lot of ways, I think looking at like from a political standpoint, Republicans and Democrats, I think ultimately we kind of want the same thing. We just have a different way of going about it. And yet it's become this abrasive difference that we're never going to get to the truth over, right?
Yeah.
And so as advisors, we have to be careful with our clients, understand nobody wants to be wrong. And I'm going to argue my position with emotion because that's who I am, right? But that doesn't necessarily make me right. If I just said I'm right and I'm not going to listen to anything you have to say, we're never going to grow. We're never going to find absolute truths, right? I'm still, as long as I've been doing this, I still learn new cool things in the financial world that maybe somebody didn't think about from a new strategy or those kind of things. And so we have to be open to listen to them. And I think that every decision is an emotional decision, right? Ultimately, it's not a mathematical decision, but I think the math can help demonstrate and help us get an emotion around that decision and understanding where the truth is. So going back to the question you actually asked, sometimes it works well. And I know somebody who's truly seeking the best for their client. And that is the person that says in class, and it's always fun for me, man, I've been told this 30 years and you just proved to me that it wasn't correct. And I'm going to have to change what I've been doing and what I've been saying to my clients to get it correct. That is somebody who really is seeking the truth because they're going against what they've told. They've admitted they were wrong. That is a hard thing to do. And I think that is the culture that we're creating. And that is so much fun for me to see people embrace that.
Todd, you'd mentioned that when you do have an argument or discussion that you do it with emotion. But I've seen you speak multiple times. I've been to your training. I've seen the videos. It's very logical. I'm telling you, next time I see you in person, I'm going to create an argument, and I want to see Todd, the emotion Langford. I want to see that
cool.
side.
I can say all kinds of nasty jokes about CPAs and everything else. We can
yeah. Don't hold back today, Todd.
All right,
Fire away.
Give you another one there.
Yeah. Speaking of kind of traditional mindset is changing, Here's a topic we talked about recently on our podcast. I was going to throw it to you and get some feedback here. Is the idea that for someone to be successful, they got to take on more risk to return to get a higher reward. What are your thoughts on that model?
That to me, so I think if we break it down and we understand the pieces. So first off, what is the definition of risk? And I think this is where some of that got out there. I think most people look at risk as the likelihood I'm going to hit one out of the park. That is not the definition of risk. Go look it up. It is the likelihood of loss. Okay. So if we look at it in that context, what people are literally saying is I have to increase my likelihood of total loss so I can have a higher return. Now, in what galaxy does that work? That is the craziest idea ever. Okay. And it opens the door, but I think what is the rule? When you say a lie 7 times, it becomes truth. Isn't that right?
Yeah.
And that's where that comes from. It's right in there with the idea that you're going to be in a lower tax bracket when you retire. Right?
I'm with you on that.
Where does that come from? Okay, so what determines your tax bracket? How much money you make. Right. So what you're saying is you're looking forward to having less money than you do now, so you can be in a lower tax bracket. That is not something to look forward to.
No, absolutely not. But I think it's just the bluntness of the questions and the way that you kind of rearrange those questions when you ask them, that people have accepted a lot of the truth for a long time, right? And so we got to break through and kind of knock them on the head a few times and say, hey, here's what this actually means, right? So great question, yeah.
Well, I think part of it is you can't know everything there is to know, right?
Mm-hmm.
You rely on other people to give you some of that information. And if that information confirms and helps you get to where you want to be, in other words, this idea of like being in a lower tax bracket or high risk and high reward, both of those ideas, it's like, oh, I can take on some risk. Okay, well, good. They said that would work out. And so they don't investigate it all the way out because they've got other things that they do, other things they do well. They rely on somebody else. And so when somebody just says that, it's easy to accept it if it fits their plan or makes their plan work out better in their mind. Does that make sense?
Mm-hmm.
Now, Todd, a lot of times when people first hear about IBC, and this was my reaction, this sounds too good to be true. What do you say when somebody says that?
I really don't like that because everything of value was too good to be true the moment before it was created. Or I think it's Peter Diamandis that says every idea is a crazy idea the moment before it becomes reality. Right? Mm. And so my point in that is it is a crazy idea. A lot of things are, and this one in particular, and so I think it means we need to look deeper into it, not just dismiss it. This idea of just dismissing something, say, hey, if it looked too good to be true, it is, and go on to something else, we're going to miss out on any new innovation, anything that's coming along, anything that we haven't heard of. And I think in some ways, it's almost a little ego-centered. If you say, well, I've never heard of this, so it must be crazy. It must not be true. Oh, really? You've heard of everything, huh? Right? And so we need to be open to looking at things, but we need to be smart too, right? We need to investigate it deeper. We need to see the math behind it. We need to look at all those pieces and not just immediately dismiss something because it didn't fit into our box of what we've heard in the past. And really, if we knew everything, then why would we need to ask advice from anybody?
Yeah. Speaking of kind of asking advice or just asking questions, I used one of your lines most recently. I think it was maybe a week ago or less, but we had put some policies in place, right, for a young man out in California. And I got an email kind of out of the blue that said, hey, Cameron, I want to cancel my policies. I said, we can do whatever you need to do, right? Let's discuss. So we jumped on a call and I go through this and he starts looking at it and he's like, I'm not happy with blah, 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 blah. Right. And I used one of your lines, which was compared to what? Like, what are you
Well,
comparing this to?
that's from Daniel Pink, so I don't want to take
Okay.
credit for that, but yes.
Awesome. But I asked him that and he goes, great point. Right. And I go, if you don't put it in here, where else are you going to put the money? And he's like, probably a savings account, checking account. Right. And so we had this discussion just on kind of the opportunity, and we go into opportunity cost and review some of the ideas that we discussed. But man, right, that's one of the sentiments that that I've used many, many times over the years. So thank you, and maybe tell listeners a little bit about where you got that.
Yeah, that's awesome, because that line came from Daniel Pink, but I think it's so important when we're talking about a life insurance policy. Life insurance policy really isn't an investment, right? It's a savings vehicle, and it needs to be kept in its own class. And what people want to do is compare, you know, a return. What if I put this in this special real estate deal, and and I got 25%? Well, that's going to do more than the life insurance. Well, sure, you're going to be able to do that with all your money. What's going to happen when that real estate thing goes sideways for a little while? You're going to have cash to support that, right? Well, so where is that piece? Well, I would have some savings for that money. Oh, exactly. What, at 0%, 0.5%?
Yeah.
Or would you rather do it in a life insurance policy that has a way better rate of return and has a death benefit and other pieces along with it that can make your strategy actually work out, right? And so it's that bigger picture and understanding where it is. And something along those lines that you and I talked about was the idea that with a life insurance policy, we're really looking at net, 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 right? When we look at the returns, and so often what happens in the industry is everybody wants to compare gross of another asset before any fees, taxes, all those other costs against the net of a life insurance policy. And it even is, I think, bigger than that, because what we're typically looking at with a life insurance policy is some of the minimums that we can expect from the life insurance policy. So in other words, when we look at a life insurance ledger, that assumes we park the money and there were no black swan events that ever happened that the life insurance helped us get out of. There were no opportunities that came along that the life insurance helped us take advantage of. Because we have access to that cash, it's a whole different scenario of what that impact on our financial stability and future can look like over what other assets. Because most other assets, and I usually use the or and aspect there, most other assets are or decisions. I can put it in real estate, or I can put it in the market, or I can put it here, et cetera, et cetera. And it's because once it's in those particular assets, the only way to get to the use those dollars is to liquidate the account, right? But with life insurance, it's an and asset. And when we look at what it does on paper, we're looking at minimums because we also have access to that cash, right? We could use that. So we could put money in the life insurance and still put it in real estate, right? Or other places. So there's twofold there on how the importance of understanding what those returns look like. And it's a difficult thing for people to see if it's a 2-second conversation, right? We have to go deeper. We have to look at what's going on. One of the things that I've come to recognize is that, a lie can be told in one sentence, but it takes a chapter to explain the truth.
Isn't that what comes to mind, right? Is using your calculators and presenting some of this stuff to clients, right? I think typically we get away from it, but it's not a simple answer, right? There's an education process that you're walking somebody through, and it can, as you go through in the learning process using a borrowing strategy calculator, right? That could be a 15 to 30 to 45-minute conversation pretty easily, right? Instead of just telling something what to do. So great point. Another one of your lines that I've often used, and I'm looking for a little history on this one, is there's no deals in life insurance. Give us a little background on that.
Yeah. So when we look at the financial industry as a whole, like I said earlier, the competition for life insurance is just about every other asset that's out there, because life insurance, when you really understand how it works, it's a phenomenal tool. And it's not all just about tools. It's about the strategies we used around them and the other pieces, but it's so flexible and there's so many things that we can do. It makes it hugely beneficial. But the insurance companies, they're not smart enough in a lot of ways to fight against or where the competition really is. Instead, they're fighting among each other. Oh, our dividend was better this month than yours was.
Yeah.
Last year we had a better, it's like, come on, guys. It's all this, it's the same thing. And that's what it comes down to. There's no deals in the insurance industry. And what I mean by that, it actually stretches out beyond just life insurance. It's in all insurance. It's in P&C insurance, right? Everything is about a trade-off between risk and cost for the insurance company, right? And so if you find a deal where the premiums are a lot lower than other places, then the insurance company somehow has shifted risk. And so let's look at an extreme example for a minute. Why is term insurance so cheap?
It's very little risk. Someone's
Right.
healthy, young, they're not going to die. They've done the underwriting. Yeah.
Right. And they can't keep it, right? It's going to terminate before the risk actually keeps in. In other words, what's your likelihood of dying before 65, let's say? Pretty small. What's your likelihood of dying after that? 100%.
Yeah.
Okay. So whole life insurance is a lot of risk for the insurance company. Why? So the premiums are higher because it's the right way to do it, right? Why insure during the time? I'm not saying don't do this. So let me clarify this. We need to be insured. But I'm just saying, really, we ought to be insuring after 65 more so than before. And because then it's guaranteed to pay us out, whereas term insurance is the opposite of that. We're paying for it during a time the likelihood is low, and we're getting rid of it when the likelihood is higher. And so, I think that's by design. Again, it's one of the lies that's put out there. Oh, you only need insurance during the time that you're working. Right.
Todd, in regards to kind of that risk aspect of it, I think a lot of times that is overlooked when people are assessing whole life versus IULs.
Yep.
Could you maybe enlighten us a little bit? Maybe enlighten Anthony, right?
I was going to bring up IULs. But...
Do you think he's smart enough to handle it?
Yeah, I don't know if he's. I don't know. I'll educate him later.
Todd, if you remember, we talked early on that we're keeping track of the zingers you give. Half a point on me, a full point on Cameron.
That must be CPA math there, because it's not fair, right?
Man, you're like, you have 0 on Cameron. Okay, all right. Sorry, go ahead.
A lot of times I see whole life proposed, right, or IULs are proposed as the same thing as whole life, but half the cost. Right. And I think they overlooked that risk piece. So I was hoping you could touch on that.
Sure. It's that just it cannot be. And you're exactly right about what the verbiage is. Again, a lie is told in one sentence, right?
Yeah.
Same thing as whole life for half the price. Well, you have to dig into the illustration to see where all those pieces are. And it comes down to the guarantees. And here's my take on it. So what does the word insurer mean to you?
Safety.
Yeah. How about to make sure something happens, right? And then what insurance is. And so why would you have risk on what you're calling insurance? It doesn't make sense to me why it wouldn't be guaranteed, right? And so when we're talking about insurance, to me, it ought to be guaranteed. That's what the word really means, right? And yet we don't have that with the IULs. And if you'll look at it, and it's not the I part of UL. So, and what I is indexed UL, but what happened in the UL industry, the universal life industry, was it started with interest sensitive universal life. When that stuff kind of started coming apart because it was minimally funded and some other things that were happening, they moved to other pieces, investment type of universal life, where you could put it into the market and play with those pieces. When that stuff started coming apart, what did they do? They went to index universal life. It's still all built on the same universal life chassis. It's just the crediting was changed through those various iterations. And so we still have the same product. And the idea is, so let's go back to what we were talking about that permission slip of being able to spend money because we know something's going to happen in the future. And that changes the strategies that we can use to be more efficient around the other assets that we have. Well, we can do that with whole life because it's guaranteed to pay. right? And if we outlive it, it's guaranteed to pay. What do I mean by that? Well, it endows, right? Currently at age 120, if we live past that, then they're going to pay us that money. So it's going to happen, even if we don't die. But a UL policy is never paid up.
That to me, well, man, there's a lot of risks with the IULs, but the ability to never pay it up, meaning no more premiums are required and it's not going to jeopardize the policy itself, is such an important issue.
Yep. And so not only is that at the end, which to me is one of the biggest issues, along the way, the guarantees on the way they can move around the investments internally to make it work for the insurance company. So if they've got half the money is all they have, then they're having to push the risk off in other areas, and they're doing that through participation ratios. And what that means is, like, if it's based on a certain index of the earnings, it might be a percentage of that earning instead of the whole amount of the earnings. There's caps in there on what the top end is. In other words, if the index was showing a 15% return, they might have a cap at 8 or 9%. So you don't get to take advantage of the high side. And they do it by saying, well, you don't also have to take advantage of the low side. But I don't think it's worth it for the trade-off. And again, it's insurance. It ought to be guaranteed.
Well, Todd, you know what? I don't care about the guarantees. I don't care about the death benefit. The IUL is going to grow with the stock market, and that's going to bring me more money that I could use as tax-free in retirement.
Then what I would say is here's my thought.
Mm-hmm.
That would be to buy put money in the stock market and buy Whole Life. No. Difference, right? No, but really, why have the UL? Why not just have term insurance? And here's my thought on it. Is there a traditional need for the death benefit during the working years?
Yes.
Yeah, absolutely. Right. We have to protect. What happens if something happens to us? Do we not want our kids to still go to the schools we had planned for them and all those pieces? So at a minimum, we need to be replacing our income in the unlikely event of a premature death, right? It could happen. It happens. Okay. So we need to cover that. But beyond that, and let's say we were planning on retiring at 70, if we have a tool that will cover us until age 80, is that helpful if we were going to retire at age 70?
Yeah.
To me, it's not helpful. If it won't go all the way, then really all we need it to do is cover our income. And with UL, it's like overpriced term insurance.
Yeah.
Right? It extends it out a little bit of time, but it's not going to make it to the age that you die, or you can't guarantee that it will. And so if it's not going to go all the way, to me, term insurance is a better option.
Now, in regard IUL, it seems like it comes in waves where people are all hot and heavy about IULs, and then it subsides. And right now, it seems like there's a wave of people bringing it up. We're not fans of IULs, and we have the information to back it up. On our website, under resources, there's a tab, why we don't recommend IULs. So in there, we compare a whole life policy, IUL policy. We have some white papers. There's some, I think that was done by Todd Langford as well, but we want to educate. And if you want to learn more from that fence in the IUL, very important for you to know the pros and cons. So I'd recommend that you check that out.
Yeah. And what you said is exactly online. That's the biggest piece, is that just don't accept it from somebody who's selling it. Either one, look at it yourself, dig through the front end of those illustrations and see where the guarantees exist and where they don't, and investigate it for yourself to see why. I just personally like the whole life insurance, knowing that the guarantees are there, right?
Speaking of figuring out for yourself, Todd, Anthony and I use your calculators, right? I think I use your calculators every day, right? But what I think is great is that, man, anybody can go right to truthconcepts.com and really buy the software for themselves and go play around in it and figure it out, right?
Oh yeah, actually they can download it for 30 days and play with it for free. So
Yeah.
yeah.
Awesome. If they go to truthconcepts.com, what else will they find?
The blog has got some great
Blog is good.
information in
Yeah.
there. So if they'll look at those pieces and go through the blog, there's a lot of ways to answer, a lot of questions that people have. How do interest rates really work? And that's something that's really not understood. And it goes back to the time value of money issue in a lot of ways. People think you can add and subtract interest rates. Well, they don't work that way, unfortunately. And so if they did, banks wouldn't have any money. Right? But it's good for the banks that people think you can just add and subtract interest rates. So it works well for them.
Well, Cameron says he uses your software every day. I use it every day and at night. Okay. So twice on Saturdays, but
Todd, thanks so much. Again, we really appreciate you being a resource for us. And then we enjoy the opportunity to kind of highlight you in front of our audience and see if they can reach out to you in any way or start following some of the content that you guys are putting out. So thanks again for coming on.
You bet. I really appreciate you guys too. I love what you're doing in this field and the fact that you're helping generations and generations of people, right?
we love what we do. Very passionate about infinite banking as you are with the math. So Todd, thanks for coming on. We appreciate it. Go make it a fantastic day.
Take care.